Welcome back to Dejan's Journal, your no hype, no BS source for daily crypto news. If you missed the noise today, we got you covered. Here are the 5 biggest crypto stories shaking the market right now. Headlines: Trump eyes executive order to protect crypto firms from debanking. Japan proposes massive crypto reclassification to enable ETFs and tax reform. Bitcoin now dominates 1 in 3 investor portfolios, says Bybit report. Ripple co-founder Arthur Britto breaks 14 years of silence. Ethereum dev proposes halving slot times to 6 seconds for faster blocks. Let's break them down. Story 1. Trump moves to stop. Operation Chokepoint 2.0. The Trump administration is reportedly drafting a new executive order that could reshape how the US banking sector interacts with politically sensitive industries, and crypto is front and center. According to the Wall Street Journal, the order would prohibit banks from denying services based on the nature of a business, particularly when the decision stems from political bias rather than risk assessment. Industries cited include firearms, fossil fuels, and crucially, cryptocurrency, which has seen dozens of founders and startups debanked in recent years. This practice, dubbed by critics as Operation Chokepoint 2.0, has been a growing concern in the crypto space. Many argue that, rather than banning digital assets outright, regulators and institutions have been silently choking the industry's access to the traditional financial system, blocking bank accounts, freezing payments, or quietly terminating services. The proposed executive order would directly challenge this tactic. If signed, it could compel banks to justify service denials with clear, documented financial reasons, not political motives or vague reputational risk. In recent months, major US banks such as JP Morgan Chase, Citigroup, and Wells Fargo have come under scrutiny for allegedly refusing service to clients in tech, energy, and crypto sectors. Some have met with regulators in states like Texas and Oklahoma to respond to accusations of biased debanking. This political shift marks a significant divergence from the Biden-era regulatory environment. Under that administration, crypto firms reported widespread difficulty accessing banking infrastructure, with over 30 founders reportedly shut out of the financial system. If implemented, Trump's proposed order wouldn't just support the crypto sector, it could become a broader statement about the limits of financial censorship and the rights of industries operating within legal frameworks to access essential banking services. For the crypto world, this could be the first major federal action that reframes financial access as a matter of constitutional and economic fairness. Story 2. Japan's bold crypto reform plan. Japan is positioning itself at the forefront of crypto regulation, and its latest proposal could change the global game. This week, the Financial Services Agency, FSA, Japan's top financial regulator, proposed a sweeping policy shift: reclassify cryptocurrencies as financial products, enable the creation of crypto ETFs, and most strikingly, introduce a flat 20% tax rate on digital asset income. Currently, Japanese crypto investors are taxed under a progressive system, with gains potentially taxed as high as 55%, a rate that has discouraged institutional investment and driven capital offshore. Moving to a flat rate, equal to that of stock investments, would not only level the playing field, but signal that Japan is ready to embrace crypto as part of its mainstream economy. But this proposal is about more than just taxes. Under the new classification, cryptocurrencies would fall under the Financial Instruments and Exchange Act, FIA, the same regulatory framework that governs securities like stocks and bonds. This change would open the door for regulated crypto ETFs, something that investors have long called for in Japan. The move is part of the country's New Capitalism Initiative, a national economic strategy launched by Prime Minister Kishida to shift Japan from a growth model based on austerity and exports to one focused on investment, innovation, and inclusive prosperity. If the proposal moves forward, Japan could become the first G7 nation to fully integrate crypto into its financial markets with clear rules, reasonable taxes, and institutional-grade products. That would not only attract local investors back into the market, but also position Japan as a global hub for crypto asset management and innovation. In a world where regulators are either stifling crypto or reacting slowly, Japan's proactive stance sends a powerful signal. Innovation and regulation don't have to be enemies, they can coexist when guided by clear frameworks and long-term vision. Story 3. Bitcoin now makes up 1 in 3 crypto portfolios. Bitcoin's role in the crypto market just got even bigger, and the numbers confirm it. According to a newly released report from Bybit, Bitcoin now represents 30.95% of the average investor's crypto portfolio, up significantly from 25.4% just 6 months ago. That's a 20% jump in allocation, a strong signal that confidence in Bitcoin is accelerating, especially among institutional players. This shift is more than just a price move, it's about positioning. As regulatory clarity improves in the US, especially after the approval of spot Bitcoin ETFs, more capital is flowing into BTC as a safe, long-term store of value within crypto. For institutions that were once hesitant, the presence of compliant, regulated investment vehicles has made Bitcoin a viable treasury asset and a hedge against fiat devaluation. Meanwhile, Ethereum is quietly losing ground. The ETH to BTC holding ratio dropped to a 2025 low of just 0.15 in April, before rebounding to 0.27, still well below its previous cycle highs. This suggests that while Ethereum continues to be seen as a powerful smart contract platform, it's no longer the automatic second choice for portfolio allocation. The trend reflects a broader shift in market psychology. Investors are moving away from speculation and toward conviction-based positioning, and Bitcoin is once again the cornerstone of that strategy. That said, altcoins aren't out of the picture. Assets like XRP are gaining renewed attention due to the growing possibility of ETF approval, a development that could trigger another wave of inflows and legitimize certain altcoins in the eyes of traditional investors. But for now, the story is clear. Bitcoin is reclaiming dominance not just on the charts, but inside portfolios. And as institutional adoption ramps up, the 1 in 3 ratio may soon look conservative. Story 4. Arthur Britto speaks, kind of. In the world of crypto, where founders are often outspoken and constantly online, silence can be more powerful than words. That's why a single emoji post from Arthur Britto, the elusive co-founder of Ripple and co-architect of the XRP ledger, has triggered a wave of speculation across the XRP community and beyond. On Monday, Britto posted for the first time ever from an X account created back in 2011. The post, just a simple face with no mouth emoji, no context, no caption, just ambiguity. For most people, it might look like nothing, but in crypto, symbolism matters, especially when it comes from someone who has been virtually invisible for over a decade. Britto is a founding figure in Ripple's history, yet he has maintained a profile so low that many newer investors don't even know his name. He's often referred to as Ripple's ghost co-founder, a Satoshi-like character who helped build one of the most influential blockchain platforms, then vanished from the public eye. This sudden reappearance raises questions that the XRP community is scrambling to answer. Why now? Is Britto preparing to speak out on Ripple's future, XRP's regulatory journey, or perhaps his own role? Is the emoji a sign of frustration, secrecy, or preparation? Ripple's current CTO, David Schwartz, quickly confirmed that the post was authentic and not the result of a hack or social engineering. That confirmation only added fuel to the speculative fire. For a community that has spent years battling FUD, lawsuits, and market volatility, any sign from the old guard is taken seriously, especially one as cryptic and open to interpretation as this. One thing is certain. In crypto, silence doesn't mean absence, and when ghosts speak, markets listen. Story 5. Ethereum dev proposes 6-second blocks, a speed revolution by 2026. Ethereum, the second largest blockchain by market cap and the foundation of decentralized finance, could soon be twice as fast. Core developer Barnaby Monod has proposed a major change to Ethereum's infrastructure, cutting block times from 12 seconds down to 6 seconds. This adjustment, laid out in Ethereum Improvement Proposal 7782, EIP 7782 would potentially roll out as part of the next major network upgrade, known as Glamsterdam, expected in late 2026. The idea is deceptively simple, but the implications are massive. Block time defines how frequently new blocks are added to the Ethereum blockchain. By halving the interval between blocks, Ethereum would dramatically reduce confirmation delays, enhance real-time responsiveness, and improve user experience across the board, especially for DeFi protocols, NFT platforms, and dApps that require high-speed execution. According to Mono, this change isn't just about speed for speed's sake. It's about increasing Ethereum's service price, a term that refers to the economic value Ethereum can capture by acting as a global settlement and execution layer. A faster chain processes more transactions, captures more gas fees, and ultimately becomes a more attractive platform for developers and enterprises alike. But what about decentralization and security? That's the key difference between Ethereum and many of its faster rivals, like Solana or Avalanche. Ethereum has traditionally prioritized decentralization and network robustness over speed, and rightly so. Monot and the Ethereum core team are designing this change carefully to ensure consensus security remains intact, even with faster slot times. And the timing is strategic. By 2026, Ethereum is expected to be operating with 3x the current gas limits and 8x the blob supply, thanks to upgrades like dank sharding and proto-dank sharding. That means the network will not only be faster, it will also handle significantly more data per second, making it a true high-throughput blockchain. In essence, this proposal is part of Ethereum's long game: scale without sacrificing its foundational principles. If EIP 7782 is adopted and implemented, Ethereum would become one of the fastest truly decentralized smart contract platforms in the world, striking a balance that few other chains have achieved. For developers, users, and investors, this could be a turning point. A faster Ethereum means lower latency, better dApp performance, and higher value per block, all while keeping the ethos of decentralization alive. The question now is, will Ethereum's community embrace this leap, or will concerns over complexity and validator pressure slow things down? From Trump's executive order to Japan's ETF revolution and Ethereum's speed boost, the crypto world is moving fast. Let us know in the comments. Which story do you think will have the biggest impact on the market this week? And don't forget to like, subscribe, and turn on notifications so you never miss the alpha. This is Dejan's Journal, signing off. Catch you Degens in the next one.